Right, how often as an investor have you heard someone say, oh, I got better than average performance, or a fund manager say, I'm better than average? Well, the word average features a lot in investing. Average property prices, average stock prices, average gains, average losses. So you might think, how hard can it be to understand, and how can I be misled? And the answer is very easily 3 ways, at least 3 ways in fact. So whenever you see the word average, have a think about what it might actually mean, and before you make a decision, make sure you understand what you're being told. Okay, so let's look at some averages. A few numbers in this video, advanced apologies for that, but nothing too tricky. So the first batch of averages we're going to look at, we all learnt them at school, but actually they're useful for investing too, are the mean, the median, and the mode. 3 ways of calculating an average from a simple population. So the fastest way to do this is to put some numbers down and see how each one works. So imagine, let's have a look at some very simple data. Imagine I've got the following stock prices in dollars for argument's sake. So $10, let's say $2, $12, $14, $14 again, and the final 2 readings are $20 and $28. So 1, 2, 3, 4, 5, 6, 7 readings of, let's say, a stock price. Could be anything, an exchange rate, house price, salary, foot size, you name it. But in this case, 7 examples of a stock price. Now, the so-called mean is the straight arithmetic average, if you like. So you might say to yourself, well, okay, what is the average? And the answer depends on what you're looking for. The so-called mean simply adds all of those up and divides by the number of items in the sample. So I've taken 7 stock price readings, add all of those up, and by no coincidence that comes to 100, and divide that by 7, you get an answer, 7 items in the population, of 14.3. So taken across 7 days, if you like that, if these are closing prices, you've got an average stock price of $14.3. Fine. And that's one way of looking at the average in that population. So you can say, well, okay, on the last day it was 28, on another day it was 2, but typically it's nearer 14.3. Okay, that's one way of looking at averages, and that's quite a common way of looking at averages. But let's now think about the problems of just doing that straight arithmetic mean, as it's known. One of them is this. That might work okay for a stock price, $14.3, but it might not work so well if you're working out the average number of rooms in houses on a housing estate, as a property developer, for example. Because if you do an arithmetic average, you might come out with an answer like 3.2. Now, you're hardly going to build new houses with 3.2 rooms in to meet what you think is that demand. Clearly, the number doesn't equate necessarily to an actual reading. It's a bit like taking average shoe sizes. You might come out with an answer of 7.14, but you'll find that Clarks and Hush Puppies, you can see how trendy I am, don't make shoes that are 7.14. You get a 7 or a 7.5. You're not going to get one that's 7.14. So the mean's fine, but often the problem is it doesn't really give you a reading you can actually do something with. So there are other ways of calculating averages, and quite often they're better. Okay, let's take another look at a sort of a sample of stock price readings, let's say. So imagine, for example, I'm looking at stock prices over, let's say, 7 days that look a bit more like this. 2, 2, 2, 2, and let's say 2, 30, 30. Right, so days 1 to 7, those are my closing prices for a particular stock. Alright, so I think, okay, let's do that average thing using a mean again. So let's add them all up. So that's 60 plus 10, which is 70. And then let's divide by the number of readings in the sample, which is 7. So the answer is, for argument's sake, $10. Okay, that's arithmetically correct. But how useful is that? If you were asking basically what typically the stock price sits at, the answer isn't that. It's often at 2 and then it's jumped the last 2 days to 30. Or if you were trying to work out the average salary across an organisation, for example, how useful would that be? Because it seems like 5 people are paid peanuts and 2 are paid loads. No one's actually paid $10. It may be strictly the mathematical average, but it doesn't equate to anything anyone actually earns. So where you've got big outliers, where you've got figures that are much bigger or smaller than the rest of the sample, the arithmetic mean really starts to become less useful. And 2 other measures of average become much more useful. Now, one is the median. The median says all you do is line up the figures you've got in the right numeric low to high sequence and literally find the one that's in the middle. So on this example, very, very straightforward because they're already in sequential order, and all I've got to do therefore is find the middle one. Now, I've made life easy for myself here because there are an odd number of items in the sample, so there is a middle one. There are 3 numbers on that side of that 2 and 3 numbers on that side of that 2, so the so-called median, the one reading that's right in the middle, is 2. And the median simply says line everything up in price order and pick the one that's right in the middle. Not quite as easy where you've got an even number of items in the sample, because then you may not have one that's exactly in the middle, you may have 2, in which case you might have to average them. The trouble with doing that is you then might end up with your kind of 14.3. You might end up with a number that isn't actually one of the items in the sample. And that can be a problem, because knowing what's right in the middle will at least take account of the outliers. That's where the median's better than the mean. It doesn't get distorted so much by big outlying numbers on the low side or the high side, but it still might not give you an exact reading like 2, which is where the mode comes in. By the way, quick check. If you're looking at a sample of items and the arithmetic mean and the median are quite close together, that shows you that you've probably got a reasonably reliable mean. So one way of checking the mean is to have a quick look at the median, and if they're not too far apart, you can probably trust the mean as being a little bit more representative of what's going on in the rest of the sample. So there we go. So we got the mean and the median, but book publishers would still say, I want to know what the most popular book is. A house builder would say, I want to know what the most popular number of rooms on this estate is. And manufacturers would say, what is the most popular shoe size, Tim? Don't give me a 7.25. We don't make any of those. Don't give me a 3.2 rooms. Give me the most popular item in the sample, what people tend to want the most. And that is the mode. The mode is simply the most popular item in the sample. Now here, very obviously, there are 5 2s and 2 30s. So the mode is also 2. So if I was trying to work out, supposing these were, for argument's sake, shoe sizes, whatever they happen to be, and you're trying to work out what do I need to make more of, the answer's got to be size 2. Not size 10, no one will buy that, all right, and not 30, but size 2. So you can see these averages have different applications depending on what you're trying to do. So the mean, very heavily quoted. The median can be much more useful. For example, if you've got a very volatile stock, up one day, down the next, or you have a big crash, the mean is going to be distorted. The median might be a more useful way to look at the numbers, and the mode, very useful in the real world when you're trying to answer the question, well, what do I actually make or sell? Because it's got to be an actual numeric item that can be made or sold, and there the mean and even the median might let you down. Right, that's our first way investors can be fooled by averages, getting the distinction between the mean, the median and the mode wrong, or not realising that they should be using one of the other 2. Second place you can go wrong is what's called, going back to the mean, geometric versus arithmetic averaging. So let's take a look at that one. Now, this one is a good one to watch out for if you're looking at the returns on a portfolio, for example, because people quite often will make a mistake as they're going too quickly. Give you an example. You've invested £1,000. Okay, and here are the returns that you get over the next 3 years. So 10%, 10%, and then the portfolio plummets 20%. Question, how are you doing at the end of year 3? Now, if you're doing an arithmetic mean at this point, you say, well, that's easy, I don't even need a calculator for this one, Tim. I put £1,000 in, I made 10% in year 1, 10% in year 2, lost 20% in year 3. Let's keep this nice and simple. 10 plus 10 minus 20 is 0. All divided by 3 is 0. The average return is 0. Not quite. Because if that's true, you'd still have £1,000 at the end of year 3. And you don't. Not if you stayed invested all the way through, you don't. So just be a little bit careful. Just going to demonstrate what I mean by that. In actual fact, £1,000, 10% gain in year 1, £1,100. Stay invested, earn another 10% on £1,100, and you end up with something a little bit more like £1,210. Then lose 20% of your portfolio. So I've multiplied 1,000 by 1.1, then by 1.1 again, and now I'm going to multiply by 0.8 for a drop of 20%, and you end up with £968. So your £1,000 isn't £1,000 anymore. And actually, the correct average return isn't 0, it's less than 0. Now, there is a way you can work this out. People who don't like numbers, I'll go through this fairly quickly. People who do, that's fine. There are geometric mean calculators all over the web if you need to do this again. But basically, the correct average annual return is done this way. Take these 3 percentages. So 1.1, 1.1, and 0.8. Those are the gains as percentages turned into straight numbers. 10% the first year, 10% in the second year, and losing 20% is the equivalent of multiplying by 0.8. Multiply those through, this sounds horrific, and then take the relevant root, 3 items in the data, so take the cube root, so 1.1 times 1.1 times 0.8, I'm going to go quickly because not everyone likes maths, take the cube root, and you end up with 0.98922. You might be thinking, what a horrible number, and it is a horrible number, but basically take that away from 1 and you end up with 0.01078 or thereabouts. Multiply by 100%. If you're wondering where this is going, good question, and you end up with just over 1%. Negative. Now, if you're thinking what was the point of all that, it's just to make one point, which is that you can clearly see intuitively that over 3 years you have lost money. £1,000 has become 968, and actually the amount you've lost annually is just over 1%. And that's what geometric means calculate. You haven't lost nothing, you've lost just over 1%. So don't worry about the numbers I just did here, not really that important, but just to make the point, it's easy to get confused as an investor staying in a fund, for example, by arithmetic and geometric means. Just be a little bit careful there. Third way you can be fooled as an investor is average performance. It's no good a fund manager saying, I made an average of 2% every year, and that put me in the top quartile during a difficult season because all my other fund managers lost 5%. Well, yes, compared to the benchmark, which is other fund managers, the fund manager making the 2% is clearly doing better than the fund managers losing money. But what if you could have left your money in a bank account and earned 4% for much less risk and just ignored the fund market altogether? That's where opportunity cost comes in. In other words, as an investor, don't settle for somebody saying, well, I'm above average. Think about what that means. Are they just saying, I'm better than all the other losers who do the same job as me. That's not good enough. What you want to think about is where else could your money have been. It takes you into the idea of absolute returns and the idea that actually as an investor you should always think, over the last 2 or 3 years, what else could I have done with my money? So if, for example, I could have had my money in cash earning 4%, really someone who's actively managing my money needs to have a pretty damn good explanation for why they're not making at least 4%, even if they're top of their peer group on a return of just 2%. So what? And that question, what else could I be doing with my money, is a question that many investors should ask when confronted with statistics about average performance. So there we are, 3 ways an investor can be fooled by the word average, and hopefully 3 ways that you won't be from now on.